What is an IRA 401k strategic rollout? Well, I'll tell you what it isn't. It's not a rollover. A rollover is going from the frying pan into the fire, so to speak. That's where so many people are duped into rolling money out of 401ks into IRAs prior to retirement, thinking they're saving tax. If they don't need the money yet or they haven't retired yet, keep deferring, keep postponing, procrastinating until you're age 72 or 73, and you have to start pulling out money to avoid a 50% penalty. And then they're told to take RMDs, required minimum distributions, to avoid a 50% penalty, thinking they're saving tax. That's the worst advice for most Americans. And so years ago, I coined a phrase, strategic rollouts, how to get money rolled out of those IRAs or 401ks, get the taxes over and done with sooner than later, when account values are lower and tax rates are lower, rather than continuing to postpone to some future perceived unknown advantage when usually tax rates are higher. And so that's called a strategic rollout. In this episode, I'm going to show you what it is in detail and give you examples of why that is smart for most Americans to perform a strategic rollout, which is not a rollover. Get ready. So I'm Doug Andrew, and I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their true or authentic wealth. And so many people, when they would prepare for retirement, they began to realize that at retirement planning was something totally different than maybe what they did for their retirement, which was usually putting money in tax-deferred IRAs or 401ks. And I think they've been duped into being told, you'll likely be in a lower tax bracket, so keep postponing paying tax until later. That has not been true or axiomatic now for over 30 years. Most savers are in as higher tax brackets during retirement as they were ever in during their golden years. If you don't understand why, hello? Most retirees, as they're socking away money, they're going down the highway of life with one foot on the gas pedal, putting money in tax-deferred IRAs and 401ks, but they've got the other foot on the brake pedal. They're killing their tax deductions. They pay off their house. They don't have the mortgage interest deduction. If they were a business owner and they sold their business to retire, they don't have that deduction anymore. They're not contributing money in retirement into IRAs or 401ks. They don't have those deductions anymore. The kids are gone, or if they move back in as adults, you can't deduct them anymore. And Congress keeps spending money and raising taxes. So most Americans will agree that taxes in the future will likely be higher. So why are you continuing to postpone, delay, procrastinate paying tax to some future perceived unknown advantage, and then withdraw your money later when we're all convinced taxes will likely be higher? So that behooves us to get the money out of those IRAs or 401ks strategically with the least tax impact. This is called a strategic rollout, not a rollover, okay? A rollover is going from the frying pan into the fire, taking money in 401ks and rolling them over to IRAs, deferring until maybe 72 or 73 years old, and then taking RMDs thinking you're saving tax. I have a software program that shows if you do that, and you continue to defer and take RMDs to your life expectancy and your spouse's life expectancy, and then pass it down to your kids, and they have to pull it out within 10 years and pay tax, you will be shocked the amount of taxes you pay by continuing to compound and increase the tax. Okay, so let's go through and explain this in a simple way. In my various books and YouTube videos, I talk about that many Americans may draw retirement income from up to 4 different resources, 1, 2, 3, or all 4. Investment income is the most common, IRAs and 401ks. Some people have real estate income from rental properties. Some people like guaranteed income, whether it's Social Security or a school teacher pension, maybe an annuity. They're not so concerned about being rich. They just don't want to be poor. If they run out of money, they don't want to run out of income. But this is the most underutilized. It's the green one, the tax-free one, okay? So let's do a little bit deeper dive into these 4. The purple one is where 91% of Americans have most of their retirement resources and yet to be taxed. IRAs or 401ks invested where? In the market. Wall Street was not designed to create predictable income, okay? And so you should not leave your money there at retirement. I would recommend no more than 30% of your income should come from that bucket. But most Americans, that's where most of it is. Now, we also have the real estate bucket, and if you have rental properties, way to go. But don't rely on that rental income to totally take care of you through your golden years. You know that real estate can go through ebbs and flows, and I've seen some people who own a lot of real estate, and all of a sudden their properties are vacant. And then the only way they can get their money out is sell the property. And so don't rely on any more than 30% of your retirement income coming from rental properties. Because rental real estate can get hurt like in 2008. Now, the orange bucket, guaranteed bucket, it could be annuities or Social Security or a pension. I recommend that between 0 to 80% of your income could come out of there, depending upon your risk tolerance. But the most underutilized, and my favorite, is the green bucket. It's tax-free. Now, municipal bonds are tax-free, but they're not very popular anymore because, there's a lot of municipalities filing bankruptcy. They're low yielding. You have Roths. Now, if you've watched very many of my videos, you'll know that I've never owned an IRA or 401k. Yeah, I never will. But I've never owned a Roth IRA or 401k, and I never will because Roths only have two advantages. They came around in 1997 when the government was hard up for tax revenue, trying to convince people to roll over to a Roth because they realized that smart Americans know they're not going to be in a lower tax bracket when they retire. So traditional IRAs or 401ks are not the answer. It would be better to have your money be tax-free, so let's get the taxes over and done with. That was rolling money over to a Roth. That created tax revenue for the government. They did it for them because they were hard up for tax revenue. They didn't do it for you. It was a step in the right direction, but Roths have too many strings attached. You can only put in a certain dollar amount, a certain percent of your income, and if you don't make too much money, you can't even have a Roth. If you put in a certain amount, but you could have put in more, you can't make up for that the next year. You can't use indexing strategies. You can lose money if your Roth is in the market, and Roths don't blossom or increase in value when you die and transfer to your heirs. A laser fund does all of those things. A laser fund has 6 advantages, and a Roth only has 2 of those 6. So why would you mess around with a Roth when it has too many strings attached, okay? So this requires the use of a strategy called a strategic rollout to get money out of this purple bucket, for example, and down here to the green one, the tax-free. Now, you can't just magically do this. You've got to get the money coming out of the IRA or 401k, whether you need it or not. You pull it out of there and get the taxes over and done with the least tax impact in today's thresholds. And then you want to reposition the net after-tax money into this green bucket that's going to be tax-free from now on. And if you use the Iowa Laser Fund, you will be reimbursed for every dollar you paid in tax during the rollout. And if you don't understand why or how, you need to watch the full videos on this topic on my channel. So let's talk about this. I mentioned that no more than 30% of your retirement income should come out of that purple bucket, even less than that. No more than 30% should be relying on you having tenants in your rental properties. Between 0 to 80% could come from the orange bucket based on risk tolerance. But I would recommend 40 to 60% of your income be totally tax-free. The IRS will know you're receiving the money because they know everything, but it doesn't show up on the front page of your 1040 tax return. It's that cut and dried. It's tax-free. It's been that way for over a century in the Internal Revenue Code. And you can learn why by studying my book. I'll let you claim a free copy of this book when we're done if you're interested. Now, in my book, I give the charts and graphs and explanations in the left brain side. On the right brain side, you flip the book over. This is actually 2 books in one. I have 62 actual client stories, and there's a chapter there about strategic rollouts. Now, I have hypothetical stories in my book of Mr. Tax to the Max versus Mrs. I Have a Lot More. In a nutshell, and I've written articles about them, and I have another one about the Smiths and the Jones, but I've written newspaper articles comparing Mr. Tax to the Max versus Mrs. I Have a Lot More. They have the exact same amount of money in IRAs or 401ks at age 59 and a half. But Mr. Tax to the Max listens to CNBC and follows the herd and he doesn't need the money yet. He's not retiring yet, even though he could access money without a 10% penalty. And so he listens to them say, oh, keep deferring, procrastinating, postponing. Because he asks his CPA, how can I save tax this year? That's myopic. He doesn't ask the CPA, how can I save tax overall in the long run? If you ask the CPA that, the CPA would have to say, oh, well, let's calculate this. And the CPA would say, you better get as much money out of the IRA or 401k starting at age 59 and a half as you possibly can before going into the next tax bracket. And so tax to the max, he defers till age 72, 73, and takes RMDs, required minimum distributions. And you can read this. He ends up with half as much income as Mrs. I have a lot more. He ends up with 40 to 50,000 a year of income. Mrs. I have a lot more has double that. And they started out on the same playing field. What does she do? Why does she have a lot more? It's because she did a strategic rollout, got the money out of her IRAs or 401ks over a 5-year period from age 59 and a half to age 64 and a half, and then went over to the green bucket, and she has tax-free income, double tax to the max, at the same age 72, let's say, the rest of her life. She got away with paying way less in tax than Mr. Taxed to the Max. Now, what is a strategic rollout? There's actually 3 different steps. You don't have to incorporate all 3. The first one is you're strategically repositioning your retirement monies, IRAs, 401ks, and so forth, and getting the taxes over and done with sooner than later, up to the current tax threshold or maybe the next one, which might only be 2% higher. I'll show you what I'm talking about in just a second. Get the taxes over and done with while the account values are lower and tax rates are lower, okay? Now, the second step, you take the after-tax monies and you reposition that into something that's going to be tax-free from now on. That would be the green bucket, okay? Now, if you use a max-funded IUL laser fund, at the end of the day, you'll be reimbursed for all the taxes you paid because when you die, it blossoms and increases in value, and Roths, of course, don't do that. Now, the third is something I usually help my clients do, and that's to offset some or all of the tax liability by resurrecting deductions that most people have been killing or creating new tax deductions on the front end. If you don't do that, you'll end up with 50 to 100% more income like Mrs. I have a lot more. But if you do this, you'll end up with sometimes up to quadruple the income, okay? So strategic rollouts in my book, in the Right Brain Side, I tell true life stories of people that we've helped. My favorite stories are about some school teachers, a real estate landlord, a husband and wife. They were both physicians, a couple in California, and one other couple. So let me give you a summary of them. We saved these school teachers. Both husband and wife had 403Bs and 401Ks and TSAs. Their advisor says postpone, delay. You don't need the money till your age. Back then it was 70 and a half, and then take RMDs. I did that, and they were flabbergasted. They were going to pay over $250,000 or more in tax by doing that. I said, let's do a strategic rollout, and we reduced the tax down to $60,000 from $250,000. And then I did some of the offsetting, and we actually got all of their money out with no tax. I saved them $250,000 of unnecessary tax. That went into their IUL laser fund. That's generating now $25,000 a year of tax-free cash flow. It actually doubled to $500,000. They have $50,000 a year of tax-free income out of money that would otherwise have gone down the drain in tax. Okay, well, I had a real estate landlord that accumulated $600,000 in his IRA to 401ks. He had $600,000 in there at the turn of the century, the year 2000. He watched that $600,000 dwindle down in value to $360,000 in 2001 to 2003 after the 9/11 terrorist attacks. And then it finally came back to $600,000 again, and it dropped down to $360,000 again in 2008. By 2012, it was finally back to the $600,000 he started with 12 years earlier. And then his advisor had the audacity to tell him to hang in there. See, the market always comes back. Well, he lost 12 years of growth. And then his advisor said, well, if your money stays in the market, just take out 4% a year. That's called the 4% rule. 4% on $600,000 is $24,000 a year. That's pathetic. I don't accumulate 600 grand in a nest egg to have a measly 24,000 a year of income, but that's before tax. He was in a 33% combined federal and state tax bracket. He had to pay $8,000 every year in tax on that $24,000 of IRA 401k income. He only netted $16,000 to buy gas, groceries, prescriptions, and golf green fees. We did a rollout, and we ended up saving him $750,000. He had several rental properties, which we resurrected deductions. We got his money out with no tax. He now has $750,000 tax-free, generating a 10% payout. What's 10% of 750? 75 grand a year tax-free. How much more is 75,000 than 16,000? Do the math. We do this all the time. We had a husband and wife who saved $4.6 million in IRAs or 401ks. And they came to me with their current advisor. And I said, you know what, I'd recommend you start getting this money out at age 59 and a half and get the taxes over and done with sooner than later. And the advisor said, well, they're going to have to pay tax if they start pulling the money out. Why would you do that? I said, to get the taxes over and done with sooner than later. And I calculated, I said, on this $4.6 million, my heavens, if you take RMDs like this advisor's telling you to do, by the time you take RMDs out to life expectancy and your spouse and you pass it down to your 3 children, and they pay tax on that, the taxes are going to be $2.6 million at least. Do you know what their advisor said? Well, they can afford that. They can afford to pay $2.6 million they have $4.6 million. I said, well, why don't we ask them? I said, I can't save you, $2.6 million. I could save you 1.2. Would you like to save 1.2 million of unnecessary tax? What do you think they said? Absolutely. We saved them that. That went into a portfolio of laser funds. It is now generating $100,000 a year of tax-free income if they live to be 120. They are so grateful. This is money that would otherwise have gone down the drain in unnecessary tax. We had a couple in California that accumulated $6 million in their IRAs or 401ks. When they saw this, they said, we want to move to 100% tax-free income. We're going to bite the bullet and pay all the tax in the highest bracket. We're never going to be in a lower bracket. So on $6 million, doing a strategic rollout, in 5 years, they paid $2 million, a third of that in tax. But it's all done now. The government should have been thrilled. What do you think the government did with that windfall? They probably spent it instead of receiving it at retirement, them taking RMDs. Well, they netted $4 million. They didn't need the money yet. In IULs, they have 4 IULs. It doubled to $8 million. They now have $8 million in their laser funds. That is generating between $600,000 to $800,000 a year of growth or income. They only need $300,000 a year to live on. They don't even have to file a tax return showing that income because it's tax-free. The IRS knows they're receiving that. They're way ahead of inflation because they're making $800 grand a year and they only need $300,000. They're making $500 grand more tax-free than they need. We do this all the time. We had a couple come to us with $2.6 million accumulated in their IRAs or 401ks. They were thumping themselves on the chest, and I said, way to go, you're savers. You're in the top, 1% of Americans. They had $2.6 million in IRAs or 401ks. They calculated conservatively if they could earn 6% or they had a 6% payout, that they could get $160,000 a year of income. They had another $40,000 coming from Social Security or their school teacher pension. So they were thumping themselves on the chest. We have $200,000 of retirement income. Well, in California, you need that just to live in a 3-bedroom home. Folks, I said, I see one big problem. They go, what's that? I said, it's all showing up on the front page of your 1040 tax return. They said, you mean there's another way? And I go, yeah. Well, what is it? I said, you're gonna at the least pay $54,000 every single year the rest of your life in tax, and taxes are gonna go up. You're only netting $146,000 to buy gas, groceries, prescriptions, and golf green fees. You want to do a strategic rollout and get 60% of that off your 1040 tax return? Yeah. In 5 years doing a strategic rollout, we got $120,000 of that $200,000 off of their 1040 tax return. The IRS knows they're receiving that. They know it's tax-free. Now, they're actually, because of the IUL laser fund, they're actually getting $240,000 of income because we increased their rate of return. Let's just compare apples to apples. For the same 200,000, they now only have to pay tax on 80,000 of the 200, not the full 200. That's 21,000. They net 178. They save 32,400 a year in tax or more. You times that out to their life expectancies, they will save between $800,000 to $1 million in tax. We do this all the time. So folks, I would implore you to take advantage of room in your current tax bracket. If you're single, let's say in the year 2024 as an example here, a single person filing a tax return, between $47,000 up to $100,000, you only pay 22% in federal tax. I guarantee you, your current tax bracket will likely be the lowest bracket you'll ever be in. If you have room there, okay, $53,000 and you don't use the room, you're going to lose it forever. Use it. Don't lose it. If you, between $100,000 and $191,000, you only pay 2% more in tax. 24%, that's probably the lowest bracket you'll ever be in. That's $91,000 of room. Use it. If you're a married couple filing a joint tax return, between $94,000 and $200,000 of taxable income, you have $106,000 of room. If you have room in that tax bracket, get it over with at 22%, or you'll be kicking yourself. Between $182,000 up to $383,000, okay, $200,000 to $383,000, you have $182,000 of room. If you have some room, you have $50,000 of room, get it out of there and pay the lowest tax you'll probably ever pay in the rest of your life. What am I talking about? The 2017 tax cuts that Trump put in, they're going to sunset or expire. And I think that's highly likely because Congress has to do nothing, and it will be one of the greatest tax increases. And so these brackets are all going to move up. This 24% bracket I was just alluding to will move to 28. Now, some people say that's only 4% more. No, it's 16.66% more money. See, if you now have to pay $28 on every $100 instead of 24 bucks, that's 16.66% more money you now have to pay out in tax than you did before. Don't wait around to pay 16.66% more in tax, okay? So that's what a strategic rollout is. If you want to learn more about it, you can learn on my channel. You can also claim a free copy of my book. Now, my book retails for $20 to $60 on Amazon. If you buy it on Amazon, thank you. But I'll give you a copy free. If you want to claim your free copy of this 300-page book, simply click on the link below or go to laserfund.com. Now, I require you contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game, okay? And then I'll pay for the book. I'll fire out a hard copy to you via priority mail. And while you're in there claiming your free copy of this book, if you like to listen and learn or watch and learn, you can invest in all kinds of education there. We teach free educational webinars every single week. You can register for one of those. You can even schedule an appointment there to talk to an IUL professional that I have trained and mentored to see how an IUL laser fund may work in your particular set of circumstances if it's done correctly. 99+% of IUL agents in America do not know how to do it correctly. I know. I've trained 5,000 of them. And I want you to make sure it's done right because it's so critical so you don't make mistakes. And you can achieve everything that I'm talking about on this channel and in my book. So here's to you and your brighter future.